Are you tired of staring at charts packed with confusing indicators, only to constantly miss the market's biggest turning points? Today, I'll show you how to spot explosive reversals using just a single candle pattern and gain the clarity and confidence to trade like a pro. Hello, traders, and welcome back to the channel. We are diving deep into that very setup today. The lizard strategy. It's a simple yet powerful price action technique that will help you trade reversals effectively, using nothing but the price on your chart. So, get ready to learn how to spot potentially explosive market turns. The lizard strategy is all about identifying a very specific single bar pattern that often signals a major reversal is about to happen. But what exactly is the lizard strategy? Let's break it down. At its core, it's a technique designed to pinpoint the exact moment a trend might be running out of steam. Think of it as a powerful signal that the market is shifting gears. This setup allows us to catch the beginning of a new move with remarkable precision, all by analyzing the story told by a single candlestick. Specifically, this pattern helps us recognize when the current trend is exhausted and the market is ready to reverse. The beauty of this strategy is that it provides a very clear and objective signal, taking the guesswork out of your entry decisions. And as you can see from this chart, the lizard pattern is incredibly easy to spot once you know what to look for. That circled candle right there is a perfect example of what we'll be learning to identify. No complex analysis needed, just a trained eye. One of the best things about this strategy is its versatility. Because it's based on universal price action principles, it works effectively across all markets, whether you're trading Forex, stocks, or crypto. However, for the most reliable signals, we strongly recommend applying it to the daily time frame. Now that we have a general idea, let's dive into the specific anatomy of a lizard candle. To correctly identify this pattern, there are 4 key characteristics you must look for. Let's break them down one by one. First, the candle must establish a new 10-day relative low for a bullish setup or a new 10-day high for a bearish one. This context is crucial because it shows the trend has reached a potential exhaustion point. Second, the candle must feature a long wick that points in the direction of the trend. This wick is the most important feature, as it visually represents a failed breakout and a strong price rejection. The third characteristic is a small body. For a bullish setup like the one shown here, the open and close prices must be within the upper quarter of the candle's entire range. This shows that despite making a new low, buyers took control and closed the price near the highs. Lastly, the candle's closing price must be within the high to low range of the previous candle. This confirms that the trend's momentum has stalled. All right, let's move from theory to practice and see what a lizard candle looks like on a real chart. In this example, we can see the price was in a downtrend. And right here, pointed out by the arrow, we have a perfect bullish lizard pattern signaling a potential reversal to the upside. Let's zoom in and apply our rules. As you can see, this candle makes a new 10-day low, pushing below the recent price action. Notice the very long lower wick. This tells us that sellers attempted to drive the price down, but faced massive buying pressure that rejected the breakout and pushed the price back up. Now for the last 2 characteristics. You can clearly see the small body of the candle, with both the open and close prices located in the upper 25% of its total range. And if you look at the candle just before it, our lizard's close is comfortably within the previous candle's range. With all four conditions met, this confirms a valid lizard setup. Let's cover the rules for a long setup. For a valid long setup, there are four conditions. First, the candle must mark a new 10-day low, as you can see here. Second, it needs a long lower wick, which signals a strong rejection of lower prices by buyers. Third, the open and close must be in the upper 25% of the bar's range. And fourth, the candle must close within the range of the previous bar. Both rules confirm that the selling pressure has faded. Our entry is placed just above the high of the lizard candle. We enter here to confirm the bullish momentum is taking over. Now, let's define our risk and place the stop loss. For our stop loss, the standard placement, or wider stop, goes just below the low of the lizard candle. This is the safest option. A more aggressive, tight stop can be placed just below the low of the entry candle, which reduces risk, but is easier to get hit. For the target, aim for a reward of at least 1.5 to 2 times your risk. Alternatively, you can target a significant nearby resistance level. Now let's cover the short setup. The rules are the exact opposite of the long setup. Here is a bearish example. First, the candle must mark a new 10-day high. Second, it needs a long upper wick, showing strong rejection from sellers. Third, the open and close are in the lower 25% of the bar's range. And fourth, the close is within the range of the previous candle. With all four rules met, this is a valid short setup. The entry for a short is placed just below the lizard candle's low. A break of this level confirms bearish momentum and triggers our trade. For the stop loss, the standard wider stop is placed above the high of the lizard candle. This is the safest placement. The more aggressive tight stop, just below the next candle's high, offers a better risk to reward, but is riskier. Your target should be at least 1.5 to 2 times your risk, or you can aim for a nearby key support level. Finally, let's cover 2 optional filters to increase the quality of your setups. First, declining volume on the breakout attempt can signal weakness. Second, and most importantly, look for the pattern to form at a key support or resistance zone. Like these examples here. A reversal at a key level is always a higher probability signal. 2 final recommendations. Stick to the daily time frame for the most reliable signals, and always avoid trading around major economic news events due to high volatility. And that's the complete lizard strategy. Thanks for watching. Let me know in the comments what you think, and what strategy you'd like to see next. If you found this useful, a like is always appreciated. Share it with other traders and subscribe so you don't miss the next video. Happy trading!